I have learned this lesson the hard way, and I paid for it in the market like every other trader who thought activity was intelligence. When I was young, I believed the market rewarded effort. I believed the man who traded the most must surely earn the most. After all, doesn't work deserve wages? But the tape taught me otherwise, and the tape never lies. It only waits for you to listen. Have you ever noticed how busy hands often come from a restless mind? The market does not pay you for motion, it pays you for judgment. That truth cost me more money than any bad tip or crooked broker ever did. I would sit there, watching prices flicker, feeling compelled to act, feeling that doing nothing was a sin. Every small move looked like an opportunity. Every tick whispered, "Trade me," and I listened. I listened far too often. There is a dangerous comfort in frequent trades. They make you feel involved, informed, alive. You mistake participation for progress. You mistake noise for signal. The chart becomes a playground instead of a map. Tell me, when you look at a chart, are you reading its story, or are you just reacting to its pulse? The big money, I found, is never in the buying or the selling. It is in the waiting. That sentence sounds dull to a man who wants action, but it is the only sentence that matters. The market spends most of its time preparing, not paying. If you trade every twitch, you are gambling on preparation instead of cashing in on completion. I have watched traders celebrate 10 trades in a day as if they earned a medal. But what did those trades say? Did they follow a primary trend, or did they simply satisfy an itch? A chart does not care about your boredom. It does not reward you for showing up. It rewards you for showing restraint. When a market is right, it is obvious. It moves with purpose. The price behaves as if it knows where it is going, even if you do not. That is when you act. Everything else is rehearsal. Why would you risk real money during rehearsal? Overtrading is rarely about strategy. It is about emotion wearing a clever disguise. Fear of missing out. Fear of being wrong. Fear of sitting still while someone else gets rich. But the market is not a race against other traders. It is a mirror. What you see in your results is what you brought to the screen. Are you trading the market, or are you trading your own impatience? I learned that a man can be right about the market and still lose money if he trades too often. Commission, slippage, hesitation, second guessing, they are silent thieves. Each unnecessary trade opens the door for them. 1 or 2 good trades, held properly, can outweigh 100 nervous ones. Yet most traders reverse that logic because it feels safer to spread their bets thin and wide. The chart speaks in trends, not in seconds. It whispers before it shouts. The man who waits for the shout has already missed the easy money. But the man who jumps at every whisper goes broke before the real move begins. Balance is not found in activity. It is found in patience guided by experience. There were times when I sat on my hands while the market drifted sideways for days. It felt uncomfortable, almost irresponsible. But when the range finally broke and the price ran like a frightened horse, I was ready. I had capital. I had clarity. The traders who exhausted themselves earlier had neither. Do you see how waiting is not laziness, but preparation? More trades do not mean more profits, because profits come from alignment, not frequency. You align with the trend, with the timing, with your own discipline. Miss one of those, and no amount of trading will save you. The market does not reward effort, it rewards correctness. A man who trades less is forced to think more. He studies longer. He questions his assumptions. He demands confirmation. A man who trades constantly has no time for thought because he is always busy fixing the damage from his last decision. Which man do you think lasts longer? I found that my best trades often came after long periods of inactivity. During those quiet stretches, I was not idle. I was observing. I was learning the market's habits, its moods, its tendencies. When the moment came, the decision felt simple. Not easy, but simple. That simplicity only comes when you are not exhausted from chasing shadows. The desire to trade every day is a dangerous habit. Markets do not owe you daily income. They offer opportunity on their own schedule. The trader who insists otherwise turns speculation into labor, and labor has fixed wages. Speculation rewards only those who wait for exceptional conditions. There is also a psychological cost to overtrading that few speak about. Every trade drains a little confidence. Even winning trades create tension because they reinforce bad habits. You begin to believe your activity caused the profit, not the market's condition. That illusion is expensive. Have you ever noticed how confidence built on luck collapses faster than confidence built on discipline? I learned to judge myself not by how often I traded, but by how well I followed my rules. A quiet day with no trades could be a success if the market offered nothing worth taking. A busy day could be a failure if every decision was forced. Once I understood that, my account stopped swinging wildly and began to grow steadily. The market will always be there tomorrow. Your capital may not. Preservation comes before multiplication. That is not cowardice, it is professionalism. A trader who survives long enough will eventually catch a major move. A trader who burns out early never gets the chance. So when you feel the urge to trade simply because the screen is flashing, pause. Ask yourself what the chart is truly saying. Ask yourself whether this is a position worth sitting with, not just clicking into. The market rewards the man who can wait as easily as it punishes the man who cannot. I have seen fortunes made in a handful of trades and destroyed in thousands. The difference was never intelligence. It was patience, timing, and respect for the market's rhythm. Everything else was noise. And if you are honest with yourself, you already know when a trade is forced and when it is right. The hard part is listening to that voice and doing nothing when nothing should be done. The market rewards waiting, not watching, and that lesson is carved into my memory deeper than any winning trade I ever made. Watching feels like work. Waiting feels like negligence. That is why most men watch themselves into losses and grow uneasy when they should be growing patient. Have you ever sat in front of a chart so long that every move starts to look important? I used to believe that staring harder at the market would make it reveal its secrets faster. I thought if I watched every tick, every small fluctuation, I could outsmart the crowd. But the market does not reveal itself to the anxious observer. It reveals itself to the man who understands when to look away. Watching too closely clouds judgment because the mind starts inventing meaning where none exists. The tape is a record, not a command. It tells you what has happened, not what you must do. When you confuse observation with obligation, you surrender control. Every flicker begins to demand action. Your hand moves before your reasoning does. Ask yourself honestly, are you responding to a signal or reacting to discomfort? Waiting is not passive. It is deliberate restraint. While the impatient trader is busy reacting to noise, the patient trader is letting the market finish its sentence. Markets speak slowly when they are uncertain and loudly when they are ready. Watching every moment does not make that moment arrive sooner. It only makes you tired before it does. I learned that the best trades rarely announce themselves with excitement. They appear after boredom, after dull ranges, after long stretches where nothing seems worth doing. That is why so many traders miss them. They have already spent their capital, their confidence, and their focus on watching movements that meant nothing. The man who waits understands context. He knows that price must prove itself before money risks itself. He is not hypnotized by motion. He is guided by structure. Trends, levels, volume, time. These things matter far more than constant attention. Watching without purpose is just another form of gambling. There is also a dangerous illusion in constant watching, the belief that control comes from proximity. You think that because you are close to the screen, you can control outcomes. But markets do not reward proximity. They reward alignment. You are either aligned with the market's direction, or you are not. Watching does not change that. I have seen traders miss entire trends because they exhausted themselves trying to trade the beginning of nothing. By the time the real move started, they were emotionally flat, cautious, or broke. They had watched too much and waited too little. Do you see how attention spent too early becomes attention wasted? Waiting requires confidence. Not confidence in prediction, but confidence in discipline. You must trust that opportunities do not vanish simply because you refuse to chase them. Markets create more chances than any one trader deserves. The problem is not scarcity of opportunity, it is scarcity of patience. When you wait properly, your trades feel different. There is less urgency, less debate, less internal argument. The setup is clear because the market has done most of the work for you. Watching tries to force clarity out of uncertainty. Waiting allows clarity to arrive on its own. Many traders believe they are waiting when they are really just watching quietly. True waiting has conditions. It has rules. It has reasons. You are not waiting because you are unsure. You are waiting because the market has not met your standards. That distinction separates professionals from hopeful amateurs. There were periods when I made no trades for weeks. Not because I was fearful, but because the market offered no edge worth taking. During those times, I protected my capital and sharpened my understanding. When the market finally aligned, the trade felt almost inevitable. Not guaranteed, but justified. Watching drains emotional capital just as surely as bad trades drain financial capital. Every moment of forced attention adds pressure. Pressure leads to mistakes. Mistakes lead to overcorrection. Overcorrection leads to losses. Waiting breaks that cycle before it begins. The market does not need your supervision. It has moved for generations without you, and it will continue long after. Your job is not to watch it endlessly, but to act decisively when conditions are right. Everything else is interference. If you feel restless while waiting, that restlessness is information. It tells you something about your relationship with risk and control. The trader who cannot wait cannot hold. The trader who cannot hold cannot capitalize. Profits favor those who can sit through discomfort without manufacturing action. I learned to step away from the screen when nothing meaningful was happening. Distance improved my judgment. Silence sharpened my timing. The fewer unnecessary moments I spent watching, the clearer the important moments became. The market rewards waiting because waiting preserves strength. Strength allows conviction. Conviction allows size. And size, applied at the right moment, is what makes a trade matter. Most losses are born not from bad analysis, but from bad timing driven by impatience. Watching invites impatience. Waiting disciplines it. That difference decides who survives long enough to learn. And when the moment finally comes, it never feels rushed, never feels forced, never feels like you are chasing something already gone. It feels calm, almost obvious, as if the market has been preparing you for that single decision all along. Overtrading is impatience disguised as strategy, and I know because I wore that disguise myself for years. It looks respectable on the surface. It talks in indicators, setups, confirmations, and risk ratios. It pretends to be methodical. But underneath, it is usually just a man who cannot sit still. Have you ever noticed how the urge to trade grows strongest when the market is doing the least? Impatience rarely announces itself honestly. It does not say, "I am bored," or "I am afraid to miss out." Instead, it says, "This looks good enough," or "I can manage the risk." It turns weak reasons into urgent ones. The trader convinces himself he is following a plan, when in truth he is just looking for relief from waiting. A real strategy narrows your actions. Impatience multiplies them. When you are patient, your list of acceptable trades is short. When you are impatient, everything almost fits. You start bending rules instead of following them. You trade because the market is open, not because it is right. Ask yourself, are your rules protecting you, or are you adjusting them to justify action? I found that overtrading often begins after a small win or a small loss. A win creates excitement and confidence that wants expression. A loss creates discomfort that wants repair. In both cases, the hand reaches for the next trade too quickly. The market becomes a place to regulate emotion instead of allocate capital. That is a dangerous transformation. Impatience also creates the illusion of control. By trading frequently, you feel involved, as if you are steering the outcome through effort. But markets do not bend to effort. They bend to conditions. The more you trade without those conditions, the more you expose yourself to randomness. And randomness is expensive when paid for repeatedly. A patient trader accepts that missing trades is part of the business. An impatient trader treats missed trades as personal failures. That mindset alone can destroy an account. You start chasing entries that are no longer there. You enter late, exit early, and repeat the process until exhaustion sets in. Does that sound like strategy, or does it sound like anxiety wearing a suit? The market offers infinite opportunities over time, but never all at once. Impatience compresses time. It makes you feel as though everything must happen now. But profits do not respond to urgency. They respond to alignment. When price, trend, and timing agree, the trade works. When they do not, no amount of clever execution can save it. I learned that the most dangerous trades were the ones I could explain too easily. They sounded reasonable. They had logic, but they lacked necessity. A good trade does not need to be defended. It stands on its own. If you find yourself arguing with yourself before entering, impatience is already in control. Overtrading also dulls your sensitivity to risk. One trade feels small, harmless. 10 trades feel manageable. But risk accumulates quietly. Each position may be modest, yet together they strain your judgment. When the market finally moves against you, it does so all at once, and suddenly you are managing damage instead of opportunity. There is another cost to impatience that few recognize. It robs you of perspective. When you trade constantly, you live inside the noise. Every minor fluctuation feels significant. You lose sight of the larger trend, the broader structure. The chart stops being a map and becomes a heartbeat monitor. You start reacting instead of planning. True strategy requires saying no far more often than saying yes. Impatience reverses that ratio. You say yes to avoid discomfort, to feel productive, to feel involved. But involvement is not the goal. Results are, and results come from selectivity, not volume. I have seen traders spend years refining systems when the real problem was not the system at all. It was their inability to wait for it. No strategy survives impatience. Even the best method fails when applied to conditions it was never designed for. Have you ever blamed your rules for losses that really came from breaking them? The patient trader understands that time is an ally. The impatient trader treats time as an enemy. He rushes entries, rushes exits, rushes decisions. He wants confirmation immediately and profit instantly. When neither arrives, frustration sets in. Frustration leads to revenge trades, and revenge trades are simply impatience without pretense. I learned to measure my discipline not by how many trades I took, but by how many I refused. The trades I did not take often saved me more money than the ones I did. Each refusal strengthened my confidence that I was in control of myself, not at the mercy of the screen. Impatience is also contagious. Watching others trade, hearing stories of quick gains, seeing markets move without you, all of it feeds the urge to act. But the market does not know who is watching. It does not reward participation trophies. It rewards those who arrive prepared at the right moment. When you strip away the language and the tools, overtrading is simply a lack of trust. A lack of trust in your analysis, in your timing, in your ability to wait. The solution is not more indicators or faster execution. It is fewer decisions made with greater conviction. I began to notice that my best trades felt quiet. There was no rush to enter, no need to prove anything. The trade either met my conditions or it did not. If it did not, I moved on without regret. Regret is a luxury the impatient trader cannot afford. The market tests patience more often than intelligence. Anyone can learn patterns. Few can wait for them to matter. That is why impatience keeps disguising itself as strategy, because admitting it would require facing the one opponent you cannot outthink, only outwait. And every time you feel the urge to trade simply to feel engaged, that moment is offering you a choice between discipline and impulse, between strategy and disguise, between waiting for the market to come to you or chasing it as it moves away, because impatience never asks whether the trade is necessary, only whether you are uncomfortable enough to take it. Capital is ammunition, not a trigger, and once I understood the distinction, my trading stopped feeling like a series of reactions and started behaving like a campaign. Most traders treat money as something that must be used simply because it is there. They see cash sitting idle and feel compelled to deploy it. But idle capital is not wasted capital. It is stored strength. Have you ever felt uneasy just because you were not in a trade? A trigger is meant to be pulled often. Ammunition is meant to be conserved. When you confuse the two, you fire at shadows and wonder why you run out of bullets before the real fight begins. Every trade you take spends something more valuable than money. It spends opportunity. Once spent, it cannot be recovered in the same market condition. I learned early that losing trades hurt less than bad timing. A loss taken at the right moment is tuition. A trade taken at the wrong moment is vandalism against your own account. Capital should only be used when the odds justify the expense. Anything else is impatience pretending to be courage. The market does not reward the trader who is always loaded. It rewards the trader who is ready. Readiness is not about constant exposure. It is about having resources intact when conditions finally align. If your capital is already tied up in marginal positions, you cannot act decisively when the real opportunity arrives. You hesitate, you reduce size, you compromise. And compromise is expensive. Many traders fear missing trades more than they fear losing money. That fear pushes them to treat capital like a trigger. Every setup looks like a reason to fire. But firing without advantage only alerts the market to your presence without causing damage. The market does not flinch. It waits for you to empty your magazine. I found that the more I respected my capital, the fewer trades I needed. Each position carried weight. Each decision mattered. When money is treated as ammunition, you ask better questions before committing it. You ask whether the trend is clear, whether the timing is right, whether the risk is justified. When money is treated as a trigger, those questions feel like delays. There is a psychological comfort in being invested. You feel involved. You feel relevant. But relevance does not pay. Results do. And results come from select moments where commitment makes sense. The trader who cannot sit in cash cannot think clearly because he is always managing exposure instead of evaluating opportunity. Capital also represents time. Every dollar lost is time lost earning it back. When you fire indiscriminately, you are trading tomorrow's opportunities for today's excitement. That is a poor exchange. The market offers occasional moments where one well-placed trade can do the work of many small ones. Those moments demand capital, not courage. I learned to look at my account the way a general looks at supplies. Not something to be spent because it exists, but something to be protected until it can be used effectively. You do not attack fortified positions with scattered fire. You wait for weakness, for confirmation, for advantage. Why should trading be any different? Overuse of capital dulls your sensitivity to risk. When you are always in trades, risk becomes background noise. You stop respecting it. You stop measuring it carefully. A single loss no longer stands out, so you accept many. Eventually they add up. Ammunition wasted in small skirmishes is not available when the decisive battle appears. There were times when the best decision I made was to do nothing and preserve capital, while others traded themselves into fatigue. When the market finally moved, I could act with size and conviction because my resources were intact. Conviction without capital is noise. Capital without conviction is waste. Treating capital as ammunition also changes how you exit trades. You are quicker to protect it. You are less willing to let losses drift. You understand that every drawdown reduces future flexibility. A trader with shrinking capital becomes cautious at the wrong time and reckless at the wrong moments. The market respects size applied correctly. Small, scattered trades rarely matter. Well-timed, well-sized positions do. But size can only be applied by those who have preserved capital. Preservation is not fear. It is strategy. Many traders believe they need to be active to stay sharp. I found the opposite to be true. Activity dulls judgment. Waiting sharpens it. When you know you are only allowed to fire under specific conditions, your mind becomes disciplined. You stop looking for excuses and start looking for confirmation. Capital is also confidence stored in numerical form. When it is intact, you trust yourself. When it is damaged, doubt creeps in. Doubt leads to hesitation, and hesitation turns good trades into poor executions. Protecting capital protects clarity. I stopped measuring success by how often I traded and started measuring it by how well I preserved my ability to trade in the future. Every day I did not lose money was a day I gained optionality. Optionality is power in the market. The trader who survives long enough will eventually see conditions align in his favor. The trader who wastes capital never stays long enough to benefit. That is why patience is not passive. It is defensive strength. When you truly understand that capital is ammunition, you stop firing at noise. You wait for structure. You wait for trend. You wait for confirmation. And waiting no longer feels like absence. It feels like preparation. The market does not need you to participate. It only needs you to be ready when it offers something worth taking. And readiness is not found in constant exposure, but in preserved strength, controlled risk, and the discipline to hold fire while others empty their accounts, trying to feel engaged. Boredom ruins more traders than losses ever will, because losses teach and boredom seduces. A loss announces itself loudly. It demands attention. Boredom whispers. It tells you nothing is happening, and that silence becomes unbearable to the undisciplined mind. Have you ever noticed how the urge to trade grows strongest when the market is quiet? When a trader is bored, he begins to confuse inactivity with incompetence. He feels as though he should be doing something, anything, to justify his time in front of the screen. The chart becomes less a guide and more a provocation. Every small movement looks like a signal simply because there are no real ones. That is how boredom turns observation into invention. Losses come from mistakes, but boredom creates mistakes where none were necessary. A losing trade taken for a sound reason still carries information. A trade taken to escape boredom carries only regret. One can be analyzed. The other only exposes weakness. Which one do you think repeats more often? The market is dull by nature. It spends far more time resting than moving. That is not a flaw, it is its rhythm. The trader who expects constant excitement has chosen the wrong profession. Speculation rewards patience, not stimulation. If you need entertainment, the market will gladly take your money in exchange for it. Boredom also erodes standards. When nothing meets your criteria, you lower them, slowly at first, just enough to feel involved. You tell yourself the setup is close enough, the risk is small enough, the move might be good enough. Enough is rarely enough in the market. Precision matters, and boredom hates precision because precision requires waiting. I have watched traders survive terrible losses and come back wiser, only to destroy themselves later during quiet periods. They could handle pain, but they could not handle stillness. Pain demands discipline. Stillness demands self-control. One is learned through experience. The other is learned through restraint. When the market is slow, boredom convinces you that you are missing something. You start scanning for action instead of waiting for clarity. You switch time frames. You add indicators. You look for complexity where simplicity would tell you to wait. Boredom turns analysis into overanalysis. There is a peculiar danger in flat markets. They lull you into activity. Small moves come and go, offering just enough motion to tempt you. You trade them, thinking you are staying sharp. In truth, you are dulling your edge. By the time the real move begins, your confidence is fractured and your capital is thinner. The trader who respects boredom understands that it is part of the cost of doing business. You are paid not just for the trades you take, but for the trades you avoid. Avoidance does not feel productive, but it is protective, and protection is what allows you to survive long enough to prosper. Boredom tests your relationship with time. The impatient trader feels time slipping away. He believes opportunity is perishable. The patient trader understands that opportunity accumulates. Time spent waiting is not lost, it is stored, but only if you do not spend it on bad decisions. Many traders believe the market owes them opportunity because they are present. Presence means nothing. The market owes no one anything. It offers movement when conditions align. Everything else is noise. Boredom is simply the space between meaningful events. I learned that boredom often arrived just before my worst trades. Not because the market changed, but because I did. My focus shifted from quality to quantity. I wanted action, not advantage. And the market is ruthless with those who trade for reasons unrelated to price. Boredom also weakens discipline by creating false urgency. You feel as though you must act now because you have already waited too long. But waiting is not a countdown. It does not expire. The moment you treat waiting as a burden, you are already preparing to break it. There is an emotional honesty in admitting boredom. It tells you that nothing is happening. That truth should guide you away from the market, not deeper into it. The trader who steps aside during boredom preserves clarity. The trader who stays engaged forces meaning into randomness. I found that my most expensive days were not volatile ones, but quiet ones. Days when nothing mattered, yet I made it matter by trading. Those losses felt avoidable because they were. They came not from misreading the market, but from refusing to accept its pace. The ability to sit through boredom is what separates professionals from gamblers. Gamblers seek action. Professionals seek advantage. Action is always available. Advantage is rare. Boredom is the price you pay for waiting for rarity. When you learn to tolerate boredom, something changes. You stop watching every tick. You stop checking positions obsessively. You regain distance. That distance restores perspective, and perspective is what allows you to see when something truly matters. Boredom is also where discipline is built. Anyone can follow rules when the market is exciting. Few can follow them when nothing is happening. The quiet hours reveal who you really are as a trader. Do you respect your plan, or do you resent it? I learned to welcome boredom as confirmation that I was not forcing trades. It became a signal that I was aligned with my rules. When boredom disappeared entirely, I knew I was probably overtrading again. The market does not test your intelligence every day. It tests your patience daily. And boredom is the tool it uses most often.